In this course, you'll learn about macroeconomics, which serves as the basis for understanding the global economy and the capital markets. For more than 50 years, the global economy grew unrestrained. In 2008, the first global recession broke out since the Second World War. A debt crisis and mass unemployment struck Europe, China showed signs of recession, and the United States began to tread water. The global crisis that inflicted serious damage primarily on developing nations made economics the most important issue on our agenda. A national economy is a complex system that includes many participants and is measured based on gross domestic product. Gross domestic product is one of the indices that serve to assess the economic resilience of a country. Based on data from the International Monetary Fund, the gross domestic product of all world nations stood at $70.03 trillion in 2008, where 62% of this sum was produced by the 10 strongest nations. Growth is what happens when this product increases. Growth is the life force not only of economics, but of the welfare of each and every one of us. When a population increases in size, growth produces work and allows the government to provide services for more people. Growth is attained by a culture of entrepreneurship, support of investments in research and development, education, and knowledge. According to John Keynes, an important British economist who developed the modern fundamentals of economics, there are 4 ways that an economy can achieve growth. 1. Private growth. Calculated by the consumption by residents of a country of final goods and services. For the last 40 years, private consumption has been one of the main sources of growth in the United States. 300 million Americans consume 4 times the amount consumed by over 1 billion Chinese. 2. Trade. This is the raw export of a country minus the raw import. The miracle that changed China from a ruined economy to the second largest world power is based largely on export. Within 30 years, its export grew by a factor of 86 to almost $2 trillion per year. 3. Investment. Investment is the purchase or sale of something with the intention of generating future returns through business activity such as training, research and development, marketing, recruiting manpower, etc. Little Estonia invested 30 to 40% of the gross domestic product of all developing economies prior to the financial crisis and became a unique Silicon Valley in Europe. Government. The government builds roads, employs teachers, and distributes stipends. The last century is characterized by an increase in government spending in the United States, in the larger European economies, and in one of the smaller ones as well. Greece increased its spending by 50% in the last 5 years and has accrued one of the largest debts in the Western world. The crisis did not take long to arrive. Economics is far more than a list of letters or formulas. It's driven by people, desires, and inclinations. We live in a time where strong forces affect us, but now we have more power over our economic destiny than we have ever had before, and therefore it is imperative that we understand how economics works. The crisis. The global economy has not yet managed to recover from the global crisis that took place in 2008. In 2007, a real estate bubble that had been forming in a number of countries reached its peak primarily in the U.S., Spain, Ireland, Britain, and Australia. The term bubble refers to significant amounts of trade and assets at prices that are inflated above the basic economic value of the assets. Housing prices started falling, borrowers stopped repaying mortgages, and the market collapsed. The economic crisis shook the global financial system, bringing enormous banking powerhouses to the brink of ruin. The United States, Britain, and other countries nationalized banks and industrial companies. In 2009, the financial crisis led to the first global recession since the Second World War, and in 2010, a debt crisis broke out in Europe as a result of the 2008 financial crisis. This crisis harmed all the different components that allow an economy to grow. Consumers saved more and spent less. Commercial investments shrunk. Companies were laying off workers. Factories were not opening. Nothing new was being made on the production lines, and innovation was stifled. When the crisis is global, customers abroad buy less and export is affected. The government has less revenue from taxes since its citizens have smaller incomes, and the government has to spend more on welfare for the needy. The result is a ballooning of government debt. The European debt crisis had serious consequences. At its peak, unemployment in Spain and Greece reached 25%. Crisis is part of the economic cycle of ebb and flow that we see throughout all of history. Prevention of financial crises that harm the economy requires thorough attention to the matters of risk management, banking supervision, and the fiscal responsibility of governments in order to maintain financial stability. In a crisis, the price is primarily paid by citizens of the countries, with suffocating unemployment, hundreds of thousands of abandoned homes, cuts to pensions and welfare, and millions descending into poverty. An entire young working generation is exiting to a market without work. The generation that is growing up now in Europe will not receive a security net from their parents. Austerity could harm growth and create a lasting economic depression. In the long term, injections of funds from governments and central banks could reinflate bubbles that ultimately form a new crisis in the future. But let's face it, the government is in trouble as well. Like households or businesses that keep balance sheets, the sale of natural resources and from companies under its ownership. And it also has expenses: salaries of public servants, building of infrastructures, training and payment of social benefits. When government spending is high, the government is referred to as a big government. When the government receives large revenues, its balance sheet improves. This happens during an economic boom, where tax collection rises or the government raises taxes. Cutting spending also improves the balance sheet. Before the crisis, many European governments were in a recession, while Ireland and Spain, as a result of the real estate bubble, had budgetary surpluses. When the crisis broke out, government spending grew around the world, and they provided incentives, provided aid to businesses and banks, and paid unemployment benefits. Because of the economic recession, tax revenues plummeted, and the result was a sharp rise in deficits. When a government spends more than it collects, it is in a budgetary deficit, and it must borrow money in order to finance its surplus expenses. This is how government debts grew to dangerous proportions. Greece collapsed, Spain and Ireland reached massive deficits, and even the United States fell deeply into debt. Printing money, interest, and inflation. Printing money or monetary expansion is the process by which a central bank increases the amount of money in its economy. Increasing money boosts an economy, but how is it done? The central bank buys financial assets from the commercial banks. It gives the banks cash as a consideration, and the banks can then lend out this money. As a result, the bank floats the economy with money, and money becomes cheaper, as an increase in the supply of a particular good automatically lowers its price. The truth is, the central banks have a simpler method for having an effect on money: the interest system. Interest is the cost of credit. If a loan is taken, interest is the price paid to whomever lends us the money. If money is deposited into a savings account, interest is our profit that the bank pays us. In other words, it is the profit made off of the loan that we have given to the bank. If the central bank decreases the base interest rate, this causes a decline in other interest rates: mortgages, loans, savings, and deposits. Interest is also influenced by risk perception. Inasmuch as a borrower is considered more secure, the interest that he is charged will be lower. At the beginning of the 80s, the base interest rate in the United States was 15%, and within 1 year it declined to zero. This happened in a number of places around the world. As a result, money became cheaper for everyone. When interest rates are low, it's a good idea to borrow money and consume, but it's not a good idea to save. Up until the crisis, a decline in interest rates stimulated growth in all areas of the economy. Private consumption grew because it was preferable to borrow rather than to save. Commercial investment expanded since it was more worthwhile to borrow money, build factories, and pay salaries. Governments could borrow money cheaply. Cheap money also stimulates trade between countries, which sounds great but also has some negative consequences. When money is cheap and demand increases, prices can rise. This is known as inflation, the great big monster of the economy. Inflation is a rise in prices accompanied by an erosion of purchasing power. Inflation erodes the value of our money. People rush out to buy before the prices rise and even hoard goods. Salaries rise and competition is harmed. The solution is raising interest rates, which makes money more expensive. Another risk of cheap money is the formation of bubbles, especially in the real estate and stock markets. Loans are taken to finance consumption and debts are accrued. Mortgages are taken to purchase houses for residency and investment purposes. Demand rises and prices rise as well. Stock market investors and investors in financial assets are high risk since safe savings are not profitable. As a result, prices of real estate and stocks generally rise without any connection to their true value. A torrent of cheap money caused the purchase and construction of houses in the decade preceding the 2008 financial crisis and caused an enormous real estate and credit bubble. In places where demand and growth were strong, the bubbles grew to exceptional proportions. Ireland and Spain are obvious examples. Upon the collapse of the markets and economies, it became apparent that even the governments took part in the cheap money party. and incurred enormous debts. Saving, investing, and globalization. Our money is used for many things: purchasing essential and non-essential items, investing in a business, and securing the future. Every household has a balance sheet of work and pension payments from which taxes are paid, and we use what remains to purchase and consume. Afterwards, money left over is known as disposable income, and we either save or invest this money. What's the difference between saving and investing? Saving is defined as storing money for future purposes, and investing is meant to increase wealth. Traditionally, saving is considered secure, and the future result is usually known in advance. Investment carries risk, and the result cannot be predicted with certainty in advance. In developed countries, there is a compulsory pension law. In other words, every worker saves money from his place of employment towards a pension. Of course, if we want to save money ourselves, we can do so as well. There is an option to save for a period of time as well. If we deposit a fixed amount every year or month, we will receive the aggregate amount at the end of the savings period, and if we are given interest on the savings, the total amount will be even greater. But one thing must not be forgotten: inflation. If we save and receive 10% interest on the money, and prices rise by 10%, we've not profited at all. If saving is such a great idea, why don't people save more and more? This is the million-dollar question. When times are good and people expect their incomes to rise, they tend to save less. When interest rates are low, people prefer to consume or look for profitable and sometimes risky investments. In the decade preceding the crisis, people bought houses with their own money and on credit. House prices rose and euphoria was created. Purchasing a house can be seen as a long-term savings because at the end of the savings period we have a house, but its worth at the time is unknown. After the crisis broke out, people reduced their consumption and started saving more. In a poor country like India, people saved around 30% of their income, while in the United States, people tend to save only around 4% of their income. In a consumption-based economy like in the United States, an increase in savings at the expense of consumption harms economic growth. What is globalization? Toyota cars are made by a Japanese corporation, but the chassis of the car are made in England, the engines in Wales, the tires in Japan, the wiring in China, the seatbelts in the Czech Republic, and the headlights in France. Like many goods that we're familiar with, these cars are manufactured in a number of different places in the world. This is an expression of globalization. In 1986, global trade reached a scope of approximately 2,000 billion US dollars, and 10 years later, it reached 5,200 billion US dollars. As a result of this 260% increase, foreign-made products that were rarely seen in countries around the world prior to globalization became a common sight. Globalization is much more than international trade, global chains, and cheap goods. Globalization is a process where countries around the world are becoming closer in a number of areas. It influences people, immigration, employment, ideas, and knowledge. 21% of Canadians were not born in Canada. 69% of Kuwaitis are foreigners, and factories of international companies are built in various places around the world, employing numerous workers. Many goods are manufactured and sold identically around the world. Globalization changes the face of society, is the source of demonstrations and revolutions, presents us with faraway cultures, and even allows us to pursue justice around the world. The main economic expression of globalization is international trade, and it brings knowledge within reach, enriches our knowledge, and expands it. World trade has grown at twice the rate of the global economy since 1960, partly as a result of globalization in the financial markets, payments, injections of capital, and cross-border investments. Global trade has caused the rise of many world powers in history: Marco Polo in 1306, Columbus in 1492, Bretton Woods in 1945, and the fall of the Berlin Wall in 1989. In the long term, it is apparent that financial empires overcame military powers. In the late 20th century, global trade made China into the power that it is. With cheap manpower, China created an enormous export machine that many claim have harmed numerous industries around the world, such as the textile industry. The factors that drive globalization cannot be stopped. The financial system. In 1907, financial panic broke out in the United States. The stock market crashed and people stormed the banks. The banker J.P. Morgan brought together the rich elite of America into a single room and forced them to loan money to the banks in order to prevent a collapse of the financial system. 101 years later, 9 heads of the largest banks in the United States congregated in a room at the Ministry of Finance and did not exit until they signed their consent to receive a government bailout of $250 billion US. Why is the financial system so important that everything must be done in order to prevent its collapse? The financial system is composed of institutions and markets. Its job is to act as a broker between those who need money or capital and those who have capital. It's responsible for allocating capital in the world. Who has capital? Households, companies, and governments that deposit in banks money that they have saved or that invest money in the capital markets. Who needs capital? Households, companies, and governments need more money than they have for household purchases, recruitment of workers, development, technology, and the building of infrastructures. Brokering is done directly through the purchase of securities, bonds, or shares. Investors basically transfer money to companies or governments, or indirectly to banks and financial institutions, which take deposits and essentially provide loans to whoever needs money. When a company sells shares, it's raising capital for its activities, and in return, it gives investors a stake in its ownership. Shareholders are meant to share in the profits of the company, which they receive as dividend payments. When a company sells bonds, it's lending money. The investor who purchases the bond is a lender, but has no ownership. He's supposed to receive interest payments of the entire loaned sum at the end of the period. An example of allocating capital through bonds is China, which purchases from its export revenues bonds of the United States government, thereby financing it. When we save and invest money, we hope to increase our capital. Pension saving, for instance, is meant to finance our retirement. In exchange for loaning money to someone else, we receive yield and our money grows. Without brokerage, the global financial system would look completely different. The achievements of the financial system are not negligible, and when it failed, the results were catastrophic. In the crisis, panic took over and trust in the financial system was destroyed. The desire to lend money dissipated. Thank you for your time, and we're certain that the more you learn, the more interesting and successful trade will be. You can find additional and more focused courses on trade that teach market basics, models, support and opposition, and more.